Something strange is happening in America right now. The stock market is booming, but the economy doesn't feel like it. Wall Street is hitting record highs. The S&P 500 keeps climbing. Tech giants are minting new billionaires every week. And yet, for millions of Americans, life feels harder. Prices are still high. Savings are shrinking. Small businesses are struggling to borrow. It's a disconnect so big, it almost doesn't make sense. Welcome to the market mirage is why stocks keep soaring. While the economy feels stuck, let's start with what everyone sees. The numbers look incredible. The S&P 500 is near all-time highs. The Nasdaq is up double digits. Corporate profits have rebounded. Investors are celebrating what looks like the soft landing everyone hoped for. But the feeling on Main Street? Totally different. Wages aren't keeping up with the cost of living. Rent, food, and insurance are still painfully expensive. Credit card balances are at record levels. Ask most Americans how the economy's doing, and they'll tell you, it's not. So how can the stock market be so strong when the real economy feels so weak? The answer lies in who's driving it, and what's really fueling the rally. First, it's important to remember, the stock market isn't the economy. It's a reflection of investor expectations, not daily reality. And right now, investors are betting on a future that looks very different from the present. They believe inflation is cooling. They believe interest rates will fall soon. They believe AI and productivity gains will power corporate profits higher. In other words, they're buying tomorrow's story, not today's struggle. That's why even with sluggish growth and weak consumer confidence, stocks keep rising. It's not about where the economy is, it's about where investors hope it's going. Second, the rally is incredibly concentrated. A handful of mega-cap tech companies, Apple, Microsoft, Amazon, Alphabet, Meta, and Nvidia, now make up more than 30% of the S&P 500's total value. When those stocks rise, the entire market looks like it's soaring, even if most others aren't. Strip out the big names, and the story changes. The average stock in America isn't doing nearly as well. Small caps, regional banks, and traditional industries are flat or falling. It's a tale of two markets, one rich, automated, and global. The other local, leveraged, and struggling. Wall Street is floating on AI optimism and corporate efficiency. Main Street is grinding under high costs and tight credit. And that divide is only getting wider. Third, there's liquidity. Even with interest rates still high, there's a huge amount of money sloshing around in financial markets. Trillions of dollars sit in money market funds earning interest. Corporate balance sheets are stacked with cash. Investors are piling into equities, convinced the Federal Reserve will start cutting rates soon. That liquidity acts like rocket fuel for markets, even when the economy is cooling. It's the financial equivalent of caffeine. It keeps things moving long after the body's tired. But it can't last forever. There's also a deeper structural issue, wealth concentration. Roughly 10% of Americans own over 90% of all U.S. stocks. So when markets rise, most of the gains flow to those already at the top, not the middle or lower income households that drive real consumer demand. That's why the wealth effect feels invisible. Stocks are up, corporate valuations are up, but everyday people don't feel richer. Their costs are still high, their wages stagnant, and their savings thin. So while the top of the pyramid celebrates record portfolios, the base is standing still. It's not that the economy isn't working, it's that it's working for fewer people. Meanwhile, many businesses, especially smaller ones, are still feeling the squeeze. Borrowing costs are high, banks are stricter, supply chains remain unpredictable. For them, the so-called soft landing doesn't look so soft. They're hiring less, investing less, and in some cases, closing shop altogether. Yet on Wall Street, those same dynamics look good. Layoffs mean lower costs. Hiring freezes mean higher margins. Slower wage growth means better earnings projections. In a strange way, what hurts workers often helps stocks. That's the cruel irony of the market mirage. What feels painful on Main Street can look profitable on Wall Street. There's another factor behind this disconnect. AI hype. Investors see AI as the next industrial revolution. They believe it will boost productivity, cut costs, and unleash trillions in new value. That belief has fueled an unprecedented surge in tech spending and in tech valuations. Companies like Nvidia, Microsoft, and Amazon are now worth more than entire countries' GDPs. But here's the catch. AI's real economic benefits may take years to materialize. Right now, much of the value is still theoretical, built on expectations, not results. If those results take longer than expected, or if profits don't follow the hype, the mirage could fade fast. So what's the takeaway? The market isn't crazy, shushihiti. It's just looking through a different lens. Wall Street trades on optimism, liquidity, and the promise of future profits. Main Street lives in the now, where groceries, rent, and bills don't care about future productivity gains. The two are moving on separate tracks. Eventually, they'll have to reconnect. The question is, how? Either the economy catches up to the markets, meaning growth accelerates, inflation eases, and real wages rise, or the markets come back down to reality, correcting when optimism outpaces results. History suggests the latter usually happens first. Right now, investors are betting that the Goldilocks scenario will hold. Not too hot, not too cold, just right for stocks to keep climbing. But if growth slows too much, or inflation flares up again, that balance could snap quickly, because the same optimism that's pushing markets up could just as easily pull them down. For now, though, the mirage keeps shimmering. Stocks are rising, portfolios are swelling, headlines are glowing. But for millions of Americans wondering why their paychecks don't stretch, why their rent's still climbing, and why the booming economy doesn't feel like one, the mirage is hard to miss. Because when Wall Street floats on hope and Main Street sinks under pressure, one thing's clear. The market may look unstoppable, but reality always catches up. And when it does, the question won't be why the mirage disappeared, but who was left standing when it finally did.